Hey there, meet Tom, a middle-class worker who just got his paycheck and notices that almost 30% of it went straight to taxes. As he reads the news on his phone, he sees headlines about billionaires like Elon Musk and Warren Buffett paying zero or nearly zero taxes, while he's paying thousands in taxes every year. You might think these billionaires are breaking the law or doing something illegal, but surprisingly, most of what they do is completely legal. So, how do they do it? Why can billionaires avoid taxes while regular people like Tom can't? And most importantly, why doesn't the government stop them? In this video, we'll break down the clever and completely legal strategies billionaires use to pay zero taxes. But wait, you might be thinking, isn't tax avoidance illegal? Well, that's where things get interesting. Let's dive in and uncover the secrets of billionaire tax strategies. Section 1. Tax avoidance versus tax evasion. First, we need to understand the difference between tax avoidance and tax evasion. Tax evasion is illegal. It's when you break the law by not paying taxes you owe. Like if you have a small business and don't report your cash income, or if you claim fake deductions on your tax return. That's tax evasion and can get you in serious trouble with the IRS. But tax avoidance? That's completely legal. It's using the tax laws to your advantage to pay less tax. Think of it like this. Imagine you're driving and see two routes to your destination. One has a $5 toll and the other is free but takes 5 minutes longer. If you take the free route, you're avoiding the toll legally. That's tax avoidance. But if you drive through the toll booth without paying, that's like tax evasion. It's illegal and can get you in trouble. Billionaires use tax avoidance, not evasion. They hire the best lawyers and accountants, often paying millions in fees, to find legal ways to pay less tax. Let's look at their main strategies. Section 2. The buy, borrow, die strategy. The first and most powerful strategy billionaires use is called buy, borrow, die. Let's break it down with an example. Meet Bob, a billionaire who owns a successful tech company. His company's shares are worth $10 billion, but he only pays himself a salary of $1 per year. Yes, you heard that right, $1. You might be thinking, how does he live? He must be paying himself under the table. But no, it's even more clever than that. Instead of selling his shares and paying capital gains tax, Bob goes to a bank and takes out a loan using his shares as collateral. Let's say he borrows $100 million. Here's the genius part. Loans aren't considered income, so he doesn't pay any tax on that $100 million. The interest rate might be just 3% because the bank knows Bob is good for it. He has $10 billion in shares as collateral. That means Bob only pays $3 million per year in interest, which is way less than the taxes he would pay if he sold shares. But wait, won't he have to sell shares eventually to pay back the loan? Well, that's where the die part comes in. When Bob dies, his heirs get his shares at what's called a stepped-up basis. This means if they sell the shares immediately, they pay almost no capital gains tax. They can use some of the money to pay off Bob's loans and keep the rest nearly tax-free. It's a strategy that's been used by wealthy families for generations. Section 3. The art of loss harvesting. The second strategy billionaires use is called tax loss harvesting. Imagine Sarah, another billionaire, who made $500 million in profits from some of her investments in 2024. Normally, she'd have to pay capital gains tax on that $500 million. But Sarah's clever accountants notice that some of her other investments have gone down in value. So in December 2024, Sarah sells both her winning and losing investments. The losses offset the gains, and suddenly, on paper, she has zero taxable income for the year. But here's the trick. In January 2025, she buys back similar but not identical investments to the ones she sold at a loss. If she bought back exactly the same investments within 30 days, it would be called a wash sale and wouldn't be allowed. But by buying similar but different investments, she keeps her investment strategy almost the same while creating paper losses to offset her gains. Section 4. The charity game. Now, let's talk about charitable donations. You might have seen headlines about billionaires donating millions to charity and thought, wow, how generous. Well, it's generous, but it's also smart tax planning. Let's say Jack, our third billionaire, owns a painting he bought for $1 million. Over time, the painting's value has increased to $50 million. If Jack sells the painting, he'll have to pay capital gains tax on the $49 million profit. Instead, he donates it to a museum. Now, he can deduct the full $50 million value from his taxable income, while never paying tax on the $49 million gain. But wait, it gets even better. Sometimes billionaires donate to their own charitable foundations, which they control. This gives them a tax deduction now while maintaining control of the assets. Plus, these foundations can pay salaries to family members and cover expenses related to charitable work like travel and conferences. Section 5. The real estate loophole. Real estate offers some of the best tax advantages, and billionaires know how to use them. Meet Mike, who owns $500 million worth of real estate. Even though his buildings are going up in value, he gets to claim something called depreciation on his taxes, basically pretending the buildings are wearing out and losing value over time, even though they're actually appreciating in value. But here's the really clever part. When one building has been fully depreciated, Mike does a 1031 exchange. He sells that building and immediately buys another one, postponing all capital gains taxes indefinitely. He can keep doing this forever, never paying capital gains tax while his real estate empire grows. This strategy is completely legal and is actually encouraged by the tax code to promote real estate investment. Section 6. The political influence. Now you might be wondering, why doesn't the government close these loopholes? Well, here's where it gets interesting. Billionaires spend millions on lobbying to keep these loopholes open. They argue that these tax advantages encourage investment and create jobs. Sometimes they even help write the tax laws through their army of lobbyists. In 2024, for example, when Congress tried to pass a minimum tax on billionaires, intensive lobbying efforts helped water down the proposal significantly. The result? The loopholes stayed open, and billionaires continued to pay very little in taxes compared to their wealth. Section 7. Why can't regular people do this? So, why can't regular people like Tom from our introduction use these strategies? Well, technically some of them can, but practically they don't work unless you're super wealthy. Here's why. You need significant assets to use the buy, borrow, die strategy. Tax loss harvesting only works if you have lots of different investments. Most people don't own art worth millions or multiple corporations. Regular people need their income for living expenses and can't wait years for tax advantage strategies to pay off. But here's something regular people can do. Understand how the system works and vote for the tax policies they believe in. After all, these loopholes exist because of laws that can be changed. If you want to learn more about these topics, check out my other videos about inflation, investing, and how money works. Remember to like and subscribe for more videos explaining complex financial topics in simple terms. Thanks for watching.